We haven't seen the full effects of what's going on in the Red Sea. We know that shipping costs, these are all skyrocketing. We'll get some more information from the producer side. If you look at the ISM Services Index that we got for January, that prices paid component jumped up to 65. That was a pretty big jump there. So these are things that are showing us that sticky inflation the Fed has warned us about. The service side, housing, wages, this is still a problem, and we may not be able to say we're completely out of the woods there.
And how lagged is a lot of this data? If you think about, for example, one thing that struck me this week was the mortgage rate climbing the most you've seen in 2 months here. And interestingly, that came before we saw the interest rate jumps this week, right? We saw the yield rise meaningfully this week in the 2-year and the 10-year. So how much more pain is there in terms of the impact of higher rates? And kind of how cyclical is this problem at this point?
Yeah, it takes a while for the full effects of the Fed rate hikes to be felt in the economy. And what you're seeing is this dispersion where the Fed has done such an aggressive rate hiking cycle. But if you look at things like financial conditions, because of the rise in equities, because of low volatility, because credit spreads are so tight, you're actually seeing financial conditions, some of these indices that are out there, financial conditions are the easiest they've been since before the Fed started raising rates. That's a problem. The Fed has said, I think the problem the Fed did is they got dovish in December, and that sparked kind of a resurgence from economic data, and that's very easy to reignite inflation. And then you put on top of that the fact that we have these issues in the Red Sea. This is a concern for inflation. Don't ever take 1 month of anything for a trend here. We're going to look at some of the underlying data, some leading indicators, and we'll see if this continues month after month to get a better idea. But it is a risk that we could see inflation kind of stall here with the progress we've made.
So what are you seeing in terms of your own predictions for the year, Megan? Are you thinking that, okay, this is just a blip, this CPI figure, or is the Fed on track to actually successfully bring inflation to its 2% target?
I think that they're on track to get it to their 2% target, but not as quickly as most anticipate. I think that it's going to be really difficult to get from where we are now down to that 2%. I'm not as optimistic that we'll see that this year. I think that may be a 2025 story. One of our themes for this year was that the Fed was walking a very fine line and that reinflation was a risk. We saw that coming into the year. They were so dovish in December. Equity markets took off. You saw spending from consumers take off. You saw consumer confidence pick up again. Those were things that concerned us about reinflation being an issue. And then you have to look at what are the markets pricing in? If the markets weren't sitting at record highs, then we might say, hey, they're not. They're being a little bit more realistic of where we are and what the Fed can and can't do. But the market just continues to notch these record highs this year, and it's disregarding a lot of these signs in the economy.
So what do you think investors are ignoring now as they engage in markets? You look at a lot of these indices near all-time highs and a lot of exuberance in certain parts of the market. After everything you've said about kind of the miscalculation of the market about rate cuts and some concerning economic data that we're seeing, how should investors be thinking about positioning?
So what we're doing is, first thing is hold extra cash. We are, as I mentioned, the Fed may be on hold for longer than most are pricing in the market. So holding extra cash isn't at the end of the world at this point. You're getting 5% on your cash levels. So holding extra cash and being able to take chances when the volatility in the market arises, which we expect. The other thing is, we just did this in the beginning of the year. Look at your portfolios. Look at where you should be, your asset allocation is. Has it deviated? It definitely has deviated in some of those areas like growth when you're looking at your portfolios. So rebalance where is necessary. That's something that is important to do. We're being patient. We're waiting for opportunities in the market. There will be opportunities. I just think right now the market's looking a little bit frothy, a little bit too optimistic, and pricing in this perfect landing, perfect inflation story for 2024.
Hey, just 40 seconds left. What kind of opportunities are you talking about here? Are you talking about opportunities of like a 1.5% pullback or something more significant?
something more significant on the large cap space for sure. But there is opportunities, we think, in the small and mid cap space because they're pricing in, I think, of a lot of the downside risks. So if you can withstand the volatility that can arise as the economy continues to weaken, I think that over the long run, you'll be rewarded in that small and mid cap space.
Hey, Megan, love it when you join us. Really do appreciate you taking the time this afternoon. That's Megan Horniman, Chief Investment Officer at Verdance Capital Advisors, joining us from Hunt Valley, Maryland. We are off of highs, Sonali, on the S&P 500, still up 22 points, about half a percentage point to 5,023. Not looking at a record close right now, but a lot can happen in the next 10 minutes. Higher about 0.1% on the NASDAQ and the Dow up 0.8%.
Yeah, you have to think about just how drastic of a move we've seen in the bond market that's underpinning these equity market moves. After that 18 basis point surge in 2-year yields on Tuesday, after that big surprise.
And 10 years are still above 420, right?
Yeah, and you also, the 2-year just under 460, it only retreated by about 9 basis points. It didn't give up all its gains.
All right, more to come. This is Bloomberg Business Week.
Company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We are minutes away from earnings from the likes of Applied Materials, Dropbox, Coinbase, and DoorDash. Right now, we have got shares of Applied Materials ahead of that report, trading higher by 0.9%. Dropbox right now up 0.3%. DoorDash up by 5.2%. And Coinbase up now by 3.3%. Stellantis, the parent of Jeep and Chrysler, is warning of a turbulent year ahead after higher costs, partially due to strikes in the U.S., and a drop in market share cut into returns in Europe and North America during the second half. But right now, we're looking at Stellantis Stellantis shares pushing higher. They're up by 6.4%. Carlos Tavares is the CEO of Stellantis, and this morning on Bloomberg Television and Radio, he told us the year ahead looks like this.
We expect 2024 to be quite turbulent, indeed quite dynamic, but you know also that Stellantis is all about sports. It's all about racing. It is in our DNA to race, which means we like turbulence. We like because it's a very competitive period in which you can demonstrate eventually that you are better than the other guys. So we like turbulence. It's an opportunity to show competitive edge for the company.
And you can hear more of the conversation on the Surveillance podcast. Again, Stellantis shares up 6.4%, GM up 1.5%, Ford shares up by 2.4%. Cisco Systems shares are lower after earnings. Cisco down now by 2.3%. The largest maker of networking equipment plans to cut thousands of jobs after a slowdown in corporate tech spending wiped out its sales growth. Again, Cisco right now trading lower by 2.3%. Those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week. Tim Stenevec and Sonali Basak in for Carol Masser this afternoon. Hey, a redhead crossing the Bloomberg terminal. Some breaking news. Apple is racing to add more AI capabilities. It's nearing the completion of a critical new software tool for app developers that would step up competition with Microsoft Corporation. Shares of Apple higher than they were earlier, but still lower on the day, down about 0.5 percentage point. Again, Apple's readying an AI tool to rival Microsoft's GitHub Copilot. This one by our own Mark Gurman, of course. February is Black History Month, and every day this month we are celebrating significant moments in U.S. Black history. Now with your installment for February 15th, here's Bloomberg's Justin Milliner.
Tim, thank you very much. On this day in Black history in 1968, Henry J. Lewis was named conductor and musical director of the New Jersey Symphony Orchestra, making him the first black person in the U.S. to lead a major symphony. Henry Lewis was born in 1932 and was a musical child prodigy. He joined the Los Angeles Philharmonic in 1948, making him the first black instrumentalist in a major symphony orchestra. By age 18, he became associate conductor of that group and eventually moved on to run the New Jersey Symphony Orchestra. Already a nationally recognized group, Henry Lewis pushed them to new heights during his tenure. They made their first appearance at Carnegie Hall. They performed at the Kennedy Center, too, during their first season. In 1970, Lewis took part in a special documentary to help people learn the basics of symphonic music. Here's his interpretation of the musical difference between Mozart and Beethoven.
Mozart was great because of what he did within the form, classicism. Beethoven wanted to create his own form. He was, like today's astronauts, on the frontier of his time. The embodiment of what was to become the feeling of his age, the magnification of emotion, the assertion of the individual, insistence on freedom and the rights of man. In short, romanticism.
That's Henry Lewis in a documentary. It was entitled The Symphony Sound with Henry Lewis and the Royal Philharmonic. That's courtesy of the Learning Corporation of America. And that is today in Black History, Tim.
That is very cool. 1968, that was such a pivotal year, too, when it comes to civil rights.
There was a ton going on, and that might seem like a little footnote, but very important for the musical world.
That's Justin Milliner with Today in Black History. Well, coming up next, we're joined by our Bloomberg TV team for our cross-platform coverage on radio, TV, YouTube, and Bloomberg Originals. Your countdown to the close starts now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Scarlett Fu here in our television studio, Tim Stenevec in our radio booth, Sonali Basak taking over for vacationing Carol Masser, as she tends to do in the middle of the week. Welcome to our audiences across all of our Bloomberg platforms. Interesting moves in the market here today, Tim. 5,029 and change on the S&P 500. You combine that with the big moves we saw yesterday, and, well, we've pretty much erased all of the the losses from Tuesday's sell-off.
Okay, so did everybody forget about that hotter than expected CPI print? Are the
did.
concerns about inflation done?
We've moved on, Tim. Sorry.
Well, it depends on who you talk to. Megan Horniman has not moved on. She's very concerned about inflation. She said that they've been warning that inflation is going to be a bumpy road to get to 2%. And she thinks, Shanali, that the Fed is on track, but it's not going to hit 2% this year. And they won't see 2% maybe until 2025. So maybe rates are higher for longer.
It's interesting because maybe the stock market might have forgotten about Tuesday, but the bond market hasn't completely forgotten about Tuesday. After that 18 basis point surge in yields on Tuesday, you only saw it come down about half that much, by 9 basis points in the last day or two, in the last 2 days, really. So we have not recovered all of those losses in the bond market yet.
Well, speaking of recovering losses, Apple has really pared back its losses. It was below its long-term trend line, its 200-day moving average, but that headline that Romain just told us about the company readying its AI tool to rival Microsoft's GitHub Copilot has moved it way off its lows.
Yeah, we're going to try to get you some more details on the latest news out of Apple. We have a lot of earnings coming after the bell tonight, including from DoorDash, Applied Materials, Coinbase, and Roku. Let's walk you through the numbers with the S&P 500 now officially recouping all of the losses from Tuesday's sell-off. A relatively decent rally today, up 29 points or about 0.6%. The Dow Jones Industrial Average up about 0.9% on the day, while the NASDAQ Composite is going to finish higher by about 47 points or 0.3%. But get this, Alex Steele, once again, the outperformer, once again, is the Russell 2000. You're starting to see that rotation really hold here. 2.4% gain on the day, 2,061 and change.
Yep, and that gap did close, so there is that. You wonder how sustainable it actually is, Tim.
Yeah, I mean, look, that's where Megan actually said there would be opportunities in volatility, would be small caps. But taking a look at large caps, the S&P 500, relatively broad-based in its gains today, peeling back the layers. 83 decliners, 417 of those stocks moved higher, Scarlett.
Yeah, and that's reflected in the industry groups. You talk about this rotation. There is a bit of rotation out of perhaps technology. With the real red spot, the red slice of the pie there is tech, down 0.4%. That's a laggard. The big advancers of the group today, energy up 2.5%, real estate investment trust up 2.4%, and materials gaining 1.9%.
Yep. All right, let's get to Applied Materials. Those earnings coming out right now. Adjusted earnings for the first quarter coming in, blowing past estimates, coming at $2.13. They also saw net sales coming in at $6.71 billion. So super solid numbers from them. Remember, we are interested to see what their China sales will be as well, particularly under any trade restrictions and rules remain.
Yeah, interesting numbers here. And you talk about this idea of what the long-term growth story is. You dig into that release, you're going to find it. Tim.
All right, well, let's look at shares of Roku, which are now lower in the after hours by about 5%. Fourth quarter net revenue coming in above estimates for 984 to 900, beating estimates of 963 million. Fourth quarter net revenue beating estimates there. Player revenue coming in above estimates as well. Adjusted EBITDA was $47.7 million. Estimates were versus a loss of year over year of $95.2 million. Estimates for $17.5 million, Scarlett.
Yeah, Roku shares right now down about 11%. How much of this is tied to streaming and like trading in sympathy with their streamers and everything that they're contending with as Roku tries to, of course, get more fees from viewers?
All right. Well, speaking of Roku here, Trade Desk really rallying here in after hours trading, the big advertising platform, reporting earnings for the fourth quarter, a big beat in the fourth quarter on revenue, $606 million. The street was looking for $582, a big beat on adjusted EPS, 41 cents a share. The street was looking for 38 cents a share. The company also announcing an additional share buyback, basically about $700 million. And the forecast and guidance going forward, $130 million in EBITDA for the first quarter, $478 in revenue for the first quarter, a beat on both of those metrics. That is your biggest gainer in after hours trading.
I just also want to get back to Applied Materials for a moment because that stock really moving as well, up 4%. The second quarter sales view actually beat estimates if you just look at the midpoint. And its net sales for the first quarter for the semiconductor systems, which is basically designing and manufacturing the systems that fabricate chips, also did really well. So, you know, you get rewarded when you deliver and you surprise, Shanali. End of story.
Yeah, you do get rewarded when you surprise. You have to also understand that their outlook here for second quarter net sales is in an interesting range here. The estimate of $6.3 billion is towards the low end, below the middle of the $6.1 billion to $6.9 billion range that they're given there.
Yeah, I'm always intrigued by the tech and the semiconductor space because it feels like there's definitely a divide between the haves and the have-nots. Anyone tied to AI, of course, does very well. And then you have someone like Texas Instruments that's struggling a little bit more because it's analog chips that's really tied more to industrial customers like car makers. And we've seen what car makers are going through with the slower than expected demand for EVs.
Digging into the press release for Applied Materials for some commentary, Gary Dickerson, the company's president and CEO, says that key semiconductor inflections support continued outperformance as customers ramp up next-gen chip tech that's critical to AI and to IoT, Internet of Things, over the next several years.
Yeah, and this gets to this idea, too, that when we talk about the development of these technologies and the actual revenue generation from them here, when do we see that? And this has been the big topic for a lot of these companies when they've come out with this. We've heard it from some of the chip companies that have a much more direct connection to this. The question is, when does that broaden out?
And just speaking of AI, just hearkening back, let me hearken to Apple for a moment, because that stock is now up 0.6%. I appreciate it in relation to, say, AMAT. It's not that big of a deal, but considering it was down, as Scarlett pointed out, below some trend lines here, it's rating its AI tool as well. And some of that software updates we're going to see in the iPad and the iPhone will contain some of those updates, which would be reportedly quite significant, Tim.
You're talking about Apple?
Yeah.
What does Zuckerberg think of it?
Okay, wait, we should, okay, go ahead, Scarlett, go ahead. I know more companies are
Yeah, he's going to
here.
film a video and post it on Instagram like he did with the Vision Pro. Let's get to DoorDash's numbers. Full year gross order value, this is the forecast here, $74 billion to $78 billion. Analysts were looking for about $76.5 billion. DoorDash also authorizes a buyback of up to $1.1 billion in stock. Right now, the stock is trading lower by 4.5%. When it comes to fourth quarter numbers, $2.3 billion, slightly higher than the expected $2.24 billion. In terms of fourth quarter adjusted EBITDA, $363 million, better than the expected $356.2 million.
Yeah, I'm just taking a look at that fourth quarter forecast, the marketplace gross order value, 18.5 to 18.9 billion. Maybe that's the reason why you're seeing a little bit of lightness in the shares right now.
Free cash flow, though, coming in $398 million for the fourth quarter. Gross order value for the first quarter also, I mean, kind of not as bad as maybe you would have thought, especially on the high end. But again, I really question how you make money on DoorDash long term.
Are you, Scarlett, are you ordering from DoorDash? We've already established Alex doesn't do that.
I don't do it.
I'm not.
No, I don't order it because I think it's highway robbery.
That's what I'm saying.
Exactly.
Okay,
no. You sound like a DoorDash.
No way. We order once a month from Uber Eats because we get a $15 credit from American Express.
Oh,
but that's enough about me.
You, Mr.
Hey, I want to talk about a little bit about these buybacks that we've been seeing from companies that you wouldn't really consider quote unquote mature companies, but they're starting to behave in a way of like legacy companies. I mean, we saw Uber do its first share buyback, what, $7 billion earlier this week? And then now DoorDash doing it, that's a big deal.
It is a big deal. You have them trying to really appease shareholders at a time where, remember, DoorDash is levered to the consumer, where a day like today and this week, we worry about what the consumer looks like over the next couple of weeks.
Yeah, absolutely. It's also kind of a bright, shiny object to distract everyone, right? When you have a buyback, it's like, hey, look over here, look over here. All right, once again, I want to go back to Apple because it came out before the market closed and it helped Apple erase the worst of its losses. Apple did finish down, but it is up in after-hours trading, and it's no longer below its 200-day moving average. It's below its 50-day and 100-day moving averages. I know technicals don't rule everything, but it was significant given how much it's been a laggard, not just this year, but since its last earnings report, the previous earnings report before the one that they announced this month.
I like me technicals. I also think it's interesting because this is sort of an MO, and you guys are going to talk to Mark Gurman in a second, but they do stuff after its competitors do, right? So they let their competitors kind of get out there, make the mistakes, do the things, and then they come in and swoop in and then make it apples. And I wonder if this was a strategy with AI also at the same time.
You make a really good point. I mean, Apple did not make the first smartphone, but many people argue it's the best one. It wasn't the first tablet, wasn't the first music player with the iPod. Really good point. Also, just a shout out to Mark Gurman for huge story moving the company's stock before the bell and then, of course, after the bell as well. That is going to do it for Beyond the Bell, our cross-platform coverage of the market close on Bloomberg TV, radio, and Bloomberg Originals and YouTube. Meantime, catch us same time, same place tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenevec and Shonali Bassick in for Carol Masser this afternoon. Shonali, that was a kind of an exciting close. We had a lot of earnings. We had some breaking news from Mark Gurman on Apple, shares of Apple moving higher as a result of that news. But there's something I want to talk about kind of big picture here. We talked a lot about real estate on the program, and we talked about this earlier this week, the vacancy rate for New York City's most expensive rentals plunging to 3.4% last year. It's the lowest in almost 3 decades. Some more details here. Available rental units costing more than $2,400 per month fell from about 13% in 2021 to, again, 3.4% last year. That's according to the New York City Housing and Vacancy Survey. This reflects a broader housing shortage in New York not seen since the 1960s. Our next guest writes that, quote, something in New York's rental market is fundamentally broken. Connor Sen is a columnist for Bloomberg Opinion. He's also the founder of Peachtree Creek Investments. He joins us from Atlanta. Check out Connor's story and more from Bloomberg Opinion on the Bloomberg and at Bloomberg.com/opinion. Connor, good to see you. Good to hear from you, as always. Another great column for the Bloomberg Opinion team. What mistakes did New York City, did regulators, did developers make to find where we are today?
Well, I think the evidence for why there's some New York exceptionalism here is that 2021 and 2022 were basically the best environment you're ever going to get to build apartments nationwide. You had low interest rates, low cap rates, so high valuations for apartments, and surging rents basically everywhere. And so the places that could built. So that's why Austin and Phoenix and Nashville and places like that now have a lot of apartments hitting the market. And New York City, to your point, is the lowest vacancy rate in 50 years. And so, there's a lot of fingers to point about how New York got here. But I think you've got to start with the fact that we do have a pretty good evidence here that something is different in New York than everywhere else.
Maybe paint a picture for us, Connor, too, about how these problems are going to lead to potentially more problems. I grew up myself outside of New York City, and you see, for example, New York's problems all of a sudden becoming problems for the tri-state area.
Well, I think you sort of look at it as 2 years of missed opportunity to build when the conditions for building were right. So even if you fixed everything on the zoning and regulatory side today, interest rates are a lot higher, valuations for apartments are a lot lower, costs are a lot higher to build. So it's not like you could just flip a magic wand and build as much as you could have 2 or 3 years ago. So there really was a cost to not doing it when things were good. And even if you fix it today, you're just not going to get as much building over the next 2 to 3 years as you would have gotten over the past 2 or 3.
Okay, so Connor, long-term implications of something like this. I mean, you write a lot about real estate. You write a lot about migration as well. I know you've looked at numbers very closely about expansion in places like Texas, places like where you live, outside of Atlanta, the greater state of Georgia, the mid-Atlantic as well. You've written a lot about this. What are the long-term economic effects of a place like New York City? Traditionally has attracted a lot of talent. The companies here have attracted a lot of talent. People who graduate from college, they need a cheap place to live, to get their career started. Talk to us about the long-term effects of something like this.
Well, I think this year in particular, New York's going to lose people to places like Texas and elsewhere that have a glut of apartments online and falling rents that would have otherwise stayed in New York. And so there's just that missed opportunity of talent that would have stayed and couldn't. And, even though people talk about taxes and housing costs in New York, the vacancy rate being what it is speaks to how desirable it remains. So it's really just a loss of talent that wants to be in New York and can't afford to because of problems in the city and sort of regulatory issues.
But do you think the poll remains the same as it was a couple of years ago as companies have cracked down on remote work, and we're seeing especially financial services and companies here in New York City requiring people to be in the office more?
What, the poll to New York, you mean?
Yeah. No, the pull away from New York. If people
sure.
Are people really going to leave New York to go to other places, even though it's expensive, if they can't work remotely?
I think you're seeing a lot of the hedge fund industry has moved to Miami. Goldman Sachs and JP Morgan have opened big presences in Dallas. So a lot of the jobs are moving elsewhere. Again, and part of that's due to cost, because with rents where they are and taxes where they are, finance feels like with the internet, they can just move elsewhere. So a lot of stuff will move elsewhere, but New York is, the beacon of opportunity and dynamism in the U.S. So I expect that to fill in. But again, it's just a loss for New York that they could have these jobs and people, but because of housing, they don't.
Connor, there are plenty of people that say, okay, good riddance, right? I mean, a lot of those workers that we're talking about are higher income workers, and the price of apartments has been astronomical in New York City. There has been another argument to be made that new people have a hard time coming in, and many people have been crowded out. Is there an argument to be made here that New York can face some sort of renaissance to pull more people in should housing finally catch a break? What would allow it to finally catch a break?
I mean, a lot of people write about zoning changes in New York, and I certainly won't disagree with that. But I think that's just is one piece of what needs to happen. I had people responding to me about the 2019 rent control law changes in New York, about how it's harder to raise rent than it was in the past, which maybe that will suppress development. I'm not an expert in that, so I have to look into that. But I think zoning's the first step, and that's really hard by itself. But even if you do that, you then have to make sure that there is still the demand to build and that builders will build.
Well, the rent control is so interesting to me, too, because you saw the issues really come to the surface, again, on a much bigger investor level when you saw ultimately the runoff effect that it had with New York Community Bank. How are you thinking about what you might want to look into with these rent control questions, and ultimately whether it will help prices go up or down in the long term, given that the rent controls potentially create a constraint on capital?
Right. So there's a lot of people who just write about zoning all the time, and I don't disagree with them, but I think that's just one piece, and so it's less interesting to me personally. I'm more of a market person, so I want to see, again, if you're a builder, what sort of economics needs to happen to build. And so it's rent costs what it does, financing is what it is, cap rates speak to valuation, so it's sort of what you can sell for after you build. And so you put that all together, and does it make sense to build? And if rent control means that you can't raise rent as much in the future, then that's going to impact cap rates, which then impacts whether or not financing can happen for development and if developers want to build. So I do think there is an impact here.
Hey, Connor, back in December, you had written a column for Bloomberg Opinion about how frustrated home buyers are about to catch a break, right? We were looking at very high mortgage rates relative to what we've seen in the last decade, I guess. But now you have had mortgage rates starting to inch up slowly once again. And that was all before, according to the data that we saw this week for last week's data, all before we saw another shoot up in yields again this week. So is there a risk here that home buyers are going to have it hard again?
It is feeling a bit deja vu, where, the end of 2022 looks like growth was slowing, and then rates maybe fall in the first half of 23, but then growth was strong in January and February, and yields shot up, and it feels like we're going through that again. The one area where home buyers definitely will catch a break this year is inventory is now rising, not falling. And it's pretty modest, but there are more homes to buy today than there were a year ago. So that is one area where they're catching a break. Mortgage rates, to your point, are looking more in the 7 range than in the mid-6s that maybe you would have thought in December. So that's definitely a challenge, but hopefully that will sort of normalize as the year goes on.
Hey, Connor, while we have you just in the last minute, I just want to get your take on the market and the rally that we've seen since October. The S&P 500 notching its 11th record so far this year today. You think stocks are moving higher too far, too fast?
I think my concern is mostly just in the AI type stuff. And I have no opinion on what NVIDIA's worth or Supermicro, but just when you see a stock like Supermicro go from 100 to 1,000 in a year and being basically the highest traded stock in the universe, that just sort of gets my alarms going. And so while that's going on, I just kind of want to step aside and wait for this to shake out before feeling too optimistic about things.
Yeah. How long was it? Nobody has a crystal ball here, but how long would a shakeout take?
I think for something like this, probably could happen pretty quickly, because I'm guessing there's a lot of hot money playing one-day options in Supermicro, or maybe the Reddit people are back at it. But you just don't want that to be the story every day, a $50 billion AI server stock.
Yeah, it is 2021 all over again, at least if the Reddit crowd is in it again. Hey, Connor, always good to catch up with you. Be sure to catch all of Connor's pieces and all of Bloomberg Opinion at OPIN Go on the Bloomberg terminal or at bloomberg.com/opinion. That's Connor Sen. He is also the founder of Peachtree Creek Investments, in addition to being a columnist for Bloomberg Opinion. We're seeing shares of Coinbase also move higher after that company reported earnings. You're listening and watching Bloomberg Business Week.
It's 421 on Wall Street. We do check markets all day long here at Bloomberg. Records on the S&P and a ton of earnings after the close of trading. Let's get right to it. Applied Materials, it is surging now by 10.1% after hours. Coinbase reported revenue for the fourth quarter that beat the average analyst estimate. Coinbase now higher by just about 7.6%. And DoorDash beat analyst estimates for delivery orders in the fourth quarter. After hours, though, right now, looking at DoorDash, DASH on the ticker, it is down now by just about 6.6%. A record on the S&P with a close at 5,029, up today by 29 points, up 0.6%. Dow Industrials up 348, up 0.9. NASDAQ up 47, a gain there of 0.3%. Russell 2000 up 2.5% today. 10-year 4.24%. Spot gold today advanced by $11 the ounce to 2004, up 0.6. West Texas Intermediate crude up 2%, 78.17 a barrel. I'm Charlie Pellett. That is a Bloomberg Business Flash.
Well, just today, the Wall Street Journal reported that Rod Stewart has sold his song catalog, as well as some of his name and likeness rights, to Iconic Artists Group for nearly $100 million. Rod Stewart joins other artists, from Bob Dylan to Bruce Springsteen to John Legend to Stevie Nicks, Neil Young, and more. We've talked about this a lot, who've cashed in by selling their catalogs. We have back with us Cherise Clark-Soros, founder and CEO of Harborview Equity Partners. She was previously a managing director at Morgan Stanley, and in addition to many other positions she holds right now, is a trustee at Carnegie Hall. You'll remember that she joined us back in October from our Screen Time event in Hollywood. Cherise, how are you?
I'm great, thank you. Thank you so much for having me again. It's great to be back with you.
Hey, we love it when you join us, and especially on a day like today. I mean, you couldn't ask for better a news peg than the Rod Stewart news earlier today. Did this surprise you at all?
No, listen, I mean, Rod is an iconic artist and one that, is deserving of value and the value creation that he's created over the generations of music. So no, it doesn't surprise me at all. There's a number of different artists, as you've mentioned so eloquently in your preamble, that have chosen to look at creating liquidity for themselves to create ultimately agency. Sometimes it's estate planning for older artists. Sometimes for younger artists, it's agency with respect to how they engage in the business overall. So it doesn't surprise me at all. The music market has been active, and some of the, legacy iconic names get all the headlines. Some artists, even artists that we work with, never announce at all and never want to be announced publicly at all because of how they engage in their personal business. But no, it doesn't surprise me, but it is so well deserved. As a kid of the 80s, who doesn't love Rod Stewart?
Well, the reason why I asked if it surprised you is because my understanding is this market has been a little soft in recent months. So is that not the case?
Listen, I mean, I think it depends on your perspective. Our point of view has always been that we are, long-standing stalwarts of the business. And so I think people who are, opportunistic tourists who, are playing, relative value versus vis-a-vis rates, they may be in and out of markets, which may feel like it's soft. We have, been very focused on this market. So we've been really active, throughout the entirety of 2023. We've had a robust and very busy first quarter. And we continue to see a lot of activity in front of us. The way that the market transacts has changed a little bit, obviously, with the rise in rates over the last 18 months or so. But I think the resiliency of the asset class, the I love music of it all, right? That we all are listening to music and engaging in music in all these various ways in our lives, whether passively or actively, has led to a resiliency that is countercyclical to everything else that we see, is truly non-correlated. So there is a change in terms of cost of capital, the cost of value and the value of money has changed for every risk asset class. There is no risk asset class that's not correlated to the cost of money. But from a resiliency perspective, you've seen that resiliency continue to play through.
Cherise, hey, Shonali Bassick here. Good to talk to you today. Over the last couple of years, you've bought catalogs tied to some really iconic names: Incubus, Brad Paisley, Wiz Khalifa. If you think about how this asset class has grown, you were really a pioneer in this world. How did the business of buying music rights become a mainstream financial asset?
Yeah. Well, I think it's two things. One, I think the science experiment is over. You know, one of my colleagues on a panel that we did earlier this month kind of really labeled it that. And I think that is true. We are sort of still in the early innings. So still, you know, capital that is still a capital constrained environment with respect to this asset class, which makes it, you know, continues to be attractive for us. But I think the way that it became really investable and scalable is twofold. One is that obviously, you know, we're living in a world where technology is the way that we consume, and that technology produces rich, very rich data. And that rich data allows for cash flows associated with that to then be understood, evaluated, and then invested in. So that's number one. I think the second is, you know, the resiliency of what we understand to be true, which we understand thematically as a firm, and we're doubling down on that, around how people engage in content. It is a royalty on the human experience, ultimately, right? And so there is nothing more non-correlated to that. You know, kind of think of it in the same bucket as people think of like core, necessary, non-discretionary needs, like, you know, healthcare, right? Like people have to get up and go to the doctor or get prescriptions. In the same way, in the music space, you know, people are listening to and engaging in music and content as a way of how they express themselves daily. And so that as a consequence has led to, and seeing that data connected to that resiliency of the human experience has led it to be something that people can think about investing in. But it's a highly fragmented cottage industry. You have to build real scalable resources around it to think about how to do that efficiently. So, you know, it is for firms that have, you know, bespoke solution sets to address the marketplace in the way that it shows up.
It's interesting because you had mentioned earlier, on one hand, non-correlated asset class, but you also started talking about the impact of higher interest rates on investors. Where does the rubber hit the road when it comes to this environment and what you're doing?
Yeah, I mean, I think, listen, you know, you've seen obviously the spreads in various markets, you know, kind of go through a variety of iterations post-pandemic, but certainly through the rate hikes over the last 18 months. I can tell you that from a financing perspective in the market with respect to music, because of the resiliency of the asset class, spreads have stayed tight, you know, and they continue to stay tight. That shows you that, you know, the despite the move in rates, it allows for you to continuously efficiently finance this, and it's because of the resiliency of the asset class. So, you know, it does reprice how people think about, you know, what the entry point is from a value perspective or from, you know, a first asset perspective for something that we look to buy. But it doesn't mean that, you know, it doesn't mean that it has created a lack of transaction opportunities, at least not for us as a firm.
It's interesting. We started this conversation on kind of the rationale for why people do sell royalties. They do sell music rights to their own catalogs. Tell us the story. Bring us behind one of the deals that you've done in the last couple of years.
Yeah, absolutely. I mean, I think, listen, there are many artists who are thinking about the next phase of their career. So you obviously see the Rod Stewarts. We purchased from the Christine McVie estate. So, you know, the key member of, or one of the key members of Fleetwood Mac. So there's lots of things that happen around estate planning, around legacy building, and around passing on that legacy to heirs. And it's so much easier to give people cash than it is to give them these pile of convoluted rights. So that's one reason. But then you also see contemporary artists, like we purchased Nelly's catalog, as you guys know, who are looking to create liquidity for themselves so they can start to think about the next phase of their career, create liquidity to create agency. You know, I think a lot of times people think that, you know, people just want money, but I think just like anything else, it's an asset in their portfolio. They're highly correlated to music and music only because that's the only thing that they do. In the same way that I used to be highly correlated to Morgan Stanley, they were my paycheck and the equity stock that I got. So I would look to create liquidity around that stock so I wasn't overly correlated to one aspect of the assets that I own. So there's a variety of different reasons why people look to engage in selling. And then, you know, what we have built is really an ecosystem where people then want to start thinking about what they want to do beyond that. And we're fortunate enough to have, you know, built an ecosystem that allows us to really engage with the artist community around what to do next, which has been really exciting. So we have some exciting things on that front coming this year.
Okay, well, maybe this will be in that realm. I have no idea what you're thinking about. But one thing that I'm thinking about when you're talking about this is in the era of AI and artificial intelligence, is there a way that artists are willing to part with their likeness in the sense from an AI perspective, and they're willing to sell those rights? Are you thinking about that at all?
I'm not sure about AI rights, but obviously we do partner with artists on name, image, and likeness all the time. And that is really around how we think about helping them to continue to achieve the goals that they want to achieve with respect to their artistry, to their catalog. And that's aligned with what it is that we need as well, because we're looking at the catalogs continuing to perform and to do well in the ecosystem. So I'm not sure necessarily about AI specific rights on people selling those. I think AI is going to be really interesting to watch, right? It's not new as has been described. Artificial intelligence has been around. It is the soup du jour, but it is going to massively change how we all kind of manipulate and engage with data. But it has to be done in a way that's safe and protective and respects existing laws with respect to copyright and copyright engagement. So I do think it'll be really interesting. I think as it relates to media and entertainment, people always play with new technologies in our space first. Think NFTs to ringtones to all of those things. But what I do think will emerge is the opportunity to do things smarter, more efficient, while also dovetailing that with creating and protecting the agency of the creator economy as well. Because those two things can't live alone. Human beings want to engage with content and music and stories that are created from the human experience, not from a generated experience. And so I do strongly believe that AI will be a tool for efficiency, but not a tool for replacement around the creative system.
Okay, that's some reassuring news to hear as somebody who does not want to be replaced by AI. Charisse, we love it when you join us. Thanks as always for taking the time. Charisse joining us from New Jersey this afternoon. Charisse Clark-Soros, founder and CEO of Harborview Equity Partners, former managing director at Morgan Stanley, among many other titles. Hey, let's get back to Washington, D.C. now to check on latest world and national news. We got Nancy Lyons in the 99.1 newsroom. Hey, Nance.
Hey, Tim. Fulton County District Attorney Fonnie Willis has been testifying this afternoon about her romance with Nathan Wade, the lawyer she hired to oversee the Georgia election interference case against Donald Trump. Here she takes a question from defense attorney Ashley Merchant.
You and Mr. Wade met in October 2019 at a conference?
That is correct. And I think in one of your motions, you tried to implicate I slept with him at that conference, which I find to be extremely offensive.
Willis and Wade both say their relationship began in 2022, even though two witnesses took the stand today and said it began in 2019. The judge will need to decide if the relationship amounts to a conflict of interest that requires Willis to be removed from the case. Earlier today, a New York judge set March 25th for the start of Donald Trump's criminal trial for alleged hush money payments to Stormy Daniels, a porn star. Trump attended that proceeding and spoke outside the courtroom.
This is a terrible time for our country. This is a real dark period for our country.
The New York trial could be the first of 4 criminal cases to be heard. The White House is downplaying the risks from an anti-satellite weapon that Russia is developing. National Security Council spokesman John Kirby says the weapon has not been deployed and there is no immediate threat, but there is a concern.
We plan to engage directly with the Russians about this, and as well as allies and partners. And as I said, we'll continue to work through what our next steps and our approaches might be.
Kirby's revelation comes a day after House Intelligence Committee Chairman Mike Turner issued a cryptic statement about an unspecified national security threat that he wanted the White House to declassify. Kansas City officials today said that yesterday's shooting that killed 1 and wounded 22 others appeared to stem from a dispute among several people. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons.
From Bloomberg World Headquarters, I'm Charlie Pellet. 4:40 the time right now on Wall Street. We do check markets all day long here at Bloomberg, keeping an eye on Applied Materials shares after hours. The stock right now rallying 11.3%. Applied is the largest American maker of chip-making machinery. It jumped in late trading after giving a bullish revenue forecast for the current period. Also reporting earnings after the close of trading, we heard from DoorDash. Now, DoorDash did beat analyst estimates for delivery orders in the fourth quarter as it expanded into new categories, and that lured a record number of monthly users who order more frequently. But after hours, we got the stock selling off. DoorDash right now is down by 8.5%. Another day of records on Wall Street for the S&P 500 index. Traders were looking past mixed economic data, sending stocks and bonds higher before an inflation reading tomorrow that will help define the Federal Reserve's next steps. Today, the S&P 500 index advanced 29 points to close at a record 5,029, up today by 0.6%. The Dow up 348, up 0.9%. Nasdaq Composite Index up 47. That was a gain today of just about exactly, as a matter of fact, 0.3%. 10-year yield 4.23%. We've got the 2-year yielding 4.58%. Spot gold today also advanced, moving higher, back above $2,000 the ounce. And again, after hours, keeping an eye on shares of Applied Materials. Applied today, right now, up by 10.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thank you so much, Charlie. Appreciate it. Here's a fun little exercise. Find someone from Pennsylvania or southern New Jersey and ask them about Wawa, and then just sit back and listen. Don't say anything. Or just listen to the celebrities. Kate Winslet called it a mythical place. Tina Fey hoisted a basket of its hoagies in a Saturday Night Live skit. Harry Styles, of all people, says it's one of his favorite things about Philadelphia. Wawa is not just a place to get gas. As Jordan Fitzgerald writes, the convenience store chain has built a fiercely loyal customer base by capturing a certain je ne sais quoi about the personality of Philly and South Jersey. But now, for the first time, the Bloomberg Billionaires Index is valuing the Wood family's net worth. That's the family that started it years ago and owns a majority stake. Jordan Fitzgerald is wealth team reporter for Bloomberg News. She's with us here in the Bloomberg Interactive Brokers studio. So drum roll, Jordan. The Wood family, the Wawa kings and queens, how much are they worth?
About $6 billion.
Okay, that's a lot of hoagies.
A lot of hoagies. The people got to have their hoagies.
The people. So how did you make this calculation? You're on the wealth team.
I have to admit, I am not a valuations person. We have, the people who can do the numbers.
You have people who do that. Okay, but take us through some of the numbers, because they do have 1,000 locations.
They have 1,000 locations. They want to build about 300 more in the coming years. They're saying it's like their biggest growth push that they've ever done. And they're pretty confident that they can make the Wawa magic transfer beyond Philly and Jersey.
It's funny, if you think about Wawa, a little bit of detail for you here, Tim. It's not your average gas station. Probably the best food I've ever had at a gas station.
It's quite crazy. I went out to various Wawas on last Friday, and I got lunch and a drink for $5. I was like, this is magic.
Well, is that why it's doing so well, that you can get that lunch and a drink for $5 at a time where inflation is just roaring in this country?
I think it's part that and part you go there and you can get everything you need in one stop. You can get, someone gets their gas pumped outside and you can run in and get all your food and coffee needed.
Especially if it's in New Jersey, where you're still not allowed to pump your own gas.
And you know what? I love having my gas pumped.
I'm not going to go on a rant here. New people from New Jersey
chill, Tim.
We outnumber you right now.
Calm down in
by
this
people from New
booth.
Jersey right now, so I'm going to sit tight. I'm not going to talk about it, but I want to pump my own gas. Okay, sorry, Shanali, you were asking.
Why now? I mean, what caught your eye about this family and their growth at this point in time?
I honestly can't take credit for that. I think the numbers people really identified that this was an area for us to focus on, and I was tapped in because I am, as we established, from New Jersey, and they were like, we're profiling you to do this, and I said, thank you!
So I have to say, as a Californian, somebody who has not frequented many Wawas, I was shocked to find that it has such a following.
Yeah.
I had never heard of it until I moved to the East Coast, and I'm wondering if the company is going to be able to take what is something regional right now and actually make it grow. Because there's another chain down south, Buc-ee's, that people freak out about. I've never been to a Buc-ee's, but apparently people love it. So different parts of the country have different things that people like. Is it transferable?
I think time will tell. They've definitely struggled a little bit with that in the past. When expanding even to northern New Jersey, they tried handing out Philadelphia Eagles calendars, and the Giants fans were not happy. And so, yeah, I do think like that is a thing people are thinking about. Like, will the Wawa magic transfer? The company's very confident that it will. The employees I talk to really think that they bring a certain level of service that anyone from any part of the country will desire. But you know, not everyone calls a hoagie. Not everyone might be looking for that.
Well, what are some of the other things that they're doing to try to attract those customers in different parts of the country?
I think they're really just trusting their business model, and they're not seeking California yet. They're really, you know, pushing down south, pushing out into the Midwest, areas that are border where they already are established and already are successful. And there might be, I think, some regional appeal that can very easily spread.
Okay, Jordan, for people listening all over the country, all over the world right now who have not been to a Wawa, talk about what you did on Friday, what you saw, and share your experience.
Yeah, I drove to about 5 different Wawa locations and observed a little bit, talked to a few people, and just tried to figure out like tried to distill the Wawa magic. And the employees seem to really enjoy the vibe that they create. Sometimes when I was talking to an employee or a customer, like people would hear me asking what they love about Wawa, and someone else would jump in and be like, "Their pizza's weirdly good," or some. And yeah, it just seems to be a thing that provokes a reaction from.
I mean,
people.
Shonali, what about you? Like, you went to college
Fun fact,
in
yeah,
Pennsylvania.
I went to a college very much down the street from a Wawa, and you know, we would just in the middle of late night studying, we would just go get wraps from Wawa. Like it would be better than the school cafeteria. That was
the bar high for that though?
That's a good question.
Exactly.
I'm wondering, Jordan, if it has to do with the fact that oftentimes stopping at a gas station to pick something up or go to the bathroom is like not a good experience. Things are disgusting. The staff doesn't want to be there. Did you get a feeling like it's sort of the opposite? It's like it's a family-owned convenience store chain, and the people who work there take pride in it.
Yeah, definitely. And it's bigger. You can get fresh food there, which you can at a lot of different convenience stores and gas stations. And I do think like they treat their employees pretty well, and their employees put that back into the customer base. They have a really, really large employee ownership program. The employees own over 30% of the company.
Wow. Okay, so talk to us a little bit about the history here and the Wood family's involvement. Because they don't own all of it.
They don't own all of it. They own a little over half. And the chain started in the 60s. The Wood family had been established in Pennsylvania for a couple hundred years, but they owned a dairy farm, and one of the scions decided, I'm going to open up a convenience store to sell our milk, and it all started from there.
Do we know why it's called Wawa?
I did look this up specifically.
Okay.
It is called Wawa because apparently their dairy farm was in a region of Pennsylvania called the Wawa region, which is like an indigenous word for like the Canada goose. So that's why there's a little goose flying over their logo.
I mean, I will tell you right now, people listening who are not in New Jersey or New York or Pennsylvania have no idea what we're talking about.
No, they have no idea, and they're probably a little weirded out. But people who are from this region, I've been getting emails all day being like, oh my God, you talked about Wawa.
Maybe we can call it like the In-N-Out burger of gas station convenience stores.
Perhaps, but I do think the Buc-ee's folks would take issue with that.
I think about it more like, when you're just driving down a long highway and you stop at a rest stop and you have like the Starbucks and the Dunkin' Donuts. It's like more like that kind of vibe than it is stopping at an Exxon, okay? Like
this is upscale consumer experience.
Employee ownership.
Yeah.
That's a big deal here. I mean, that's not something you see with types of stores like this.
No, and it seems to be a thing that they've always done. They seem to take pride in it. They advertise it on their website. And yeah, I talked to a Wawa employee who she was 20 years old. She went to Wawa every day for breakfast at high school. And when she graduated, she was like, I want to spend more time here, and decided to start working at Wawa.
Well, I will tell you, I emailed this to somebody. She will go unnamed, but she knows who she is. She's very high up here at Bloomberg in the newsroom. Because she's from Pennsylvania, I said, how many people have emailed this to you? And she said, my daughter was very upset after a softball tournament. All she wanted was a Wawa. You know what I did? I made sure to find the closest Wawa and put it into my GPS, and it solved everything. So Wawa cures everything, and Jordan Fitzgerald is a fantastic reporter, and we're so happy to have her here at Bloomberg writing about Wawa. She's wealth team reporter for Bloomberg News. She joins us in the Bloomberg Interactive Broker studio. This is Bloomberg.
your company news headlines on Bloomberg Radio.
It's 4:53 on Wall Street. From Bloomberg World Headquarters, I'm Charlie Pellet. Applied Materials, the largest American maker of chip-making machinery, is jumping in late trading after giving a bullish revenue forecast for the current period, signaling that some of the largest semiconductor companies are increasing their investments in new production. Applied Materials, after hours, rallying now by almost 12%. Coinbase reported revenue for the fourth quarter that did beat the average analyst estimate. Also, after hours, right now we do have Coinbase shares. They are trading higher by 3.3%. Among some of the other names reporting after the close of trading, we did hear from DoorDash. It beat analyst estimates for delivery orders in the fourth quarter, as an expansion into new categories is luring a record number of monthly users who order more frequently. But after hours, we've got DoorDash now lower by 7.25%. Apple is racing to add more artificial intelligence capabilities as it nears the completion of a critical new software tool for app developers that would step up competition with Microsoft. That's a scoop from Bloomberg's Mark Gurman. The Commerce Department is reporting retail sales dropped in January, posting the biggest decline in nearly a year. The data suggests Americans may have taken a post-holiday breather or stayed home because of bad weather. Today, we had a number of retailers also advancing. Target, case in point, up by 0.9%. Kohl's Corp up today by 3%. Amazon shares, though, did move lower. Amazon today down by 0.7%. And those are some of the top company stories that we are following for you at this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It's Bloomberg Business Week. Let's get a check on the latest world and national news with Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. The Biden administration is confirming Russia has obtained a troubling new weapon, but it says it is not currently operational. National Security Council spokesman John Kirby offers some details.
I can confirm that it is related to an anti-satellite capability that Russia is developing. I want to be clear about a couple of things right off the bat. First, this is not an active capability that's been deployed. And though Russia's pursuit of this particular capability is troubling, there is no immediate threat to anyone's safety.
Kirby addressed the threat after the head of the House Intelligence Committee, Congressman Mike Turner, urged the administration to declassify the information. A judge in Atlanta is hearing arguments today over whether Fulton County District Attorney Fani Willis should be disqualified from Trump's Georgia election interference case. It stems from a personal relationship with Nathan Wade, a special prosecutor she hired for the case. Robin Bryant-Eardy is a former associate of Willis's.
You have no doubt that their romantic relationship was in effect from 2019 until the last time you spoke with her? No doubt. And that's based on your personal observations and speaking with them and seeing them together and things like that. Yes.
That's defense attorney Ashley Merchant. When Fani Willis took the stand, she refuted that the relationship began in 2019 and accused the defense attorney of spreading lies. Earlier today, a judge in New York set a March 25th start for Donald Trump's criminal trial over alleged hush money paid to a porn star. Trump's attorneys tried to get a dismissal of the trial, but were turned back by the judge. And tomorrow, a New York judge is due to deliver a verdict in the Attorney General's $370 million civil fraud trial against Trump and his business. It could take a massive bite out of the former president's cash reserves and could ban him for life from the New York real estate market where he made his fortune. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Tim and Shonali.
Thank you for that update, Nancy Lyons. Really do appreciate it. As Nancy mentioned, Shonali Bassick in this afternoon for Carol Messer. I'm Tim Stenevec. And before we go, I wanted to draw everyone's attention over to an exclusive by our own Mark Gurman, who is I'm just going to say it, Shonali.
Whisperer?
Yeah, like there's nobody out there in the entire universe outside of Apple who knows more about the goings-on.
I mean, we could make
inside
this whole
Apple.
segment just about Mark.
Yeah,
honestly,
it's pretty
even
amazing.
his rivals, hail Mark because he brings so much news.
Oh, it's true. I mean, he's a legend within the Apple community.
Totally.
He's a legend outside of the Apple community, and he's been doing this since he was a kid, which is
so
amazing. Anyway, the story.
As the
I'm
story
sorry.
goes,
Go ahead.
Alphabet was down on the day because of a report that OpenAI was developing a search
Okay.
product. And then after hours, Mark, literally at 4:01, as the market closed, reported that Apple is readying its own AI tool to rival Microsoft's GitHub product here, the Copilot.
Okay.
And so you did see Apple rebound after the market closed.
Yeah, it's pretty amazing. So if you're not familiar with Microsoft's GitHub Copilot, it uses AI to predict and complete blocks of code. It simplifies the programming process for software development, potentially saving time and money. So Microsoft has something out called the GitHub Copilot. Apple, we should note, according to Mark, is also exploring the use of AI to generate code for testing applications. It's an often tedious process. Currently, Apple is putting some engineers to try these new AI features internally as part of a dog fooding effort when a company uses its own products to make sure they work properly before releasing them to outside developers.
It's interesting, Mark describes this urgency under the surface at Apple here with the vice president, senior vice president for software, really telling teams to develop as many AI products as possible when it comes to operating system updates. So you see the large tech giants really filling in that war towards using more AI to create more options for their consumers and really come on top of the other guy.
Apple's next iPhone or iPad software updates, iOS 18, will include a slew of new AI features, according to people familiar with the matter. Shonali, thank you so much
been a blast.
for filling in for Carol this afternoon. It has been a blast.
Happy
I really
Friday
appreciate
Eve.
it. Happy Friday's Eve, everyone. That does it for Bloomberg Business Week. I'm Tim